Hi everyone, welcome. Uh, External source of funding, the main definition of financing, like normally coming from outside the organization. Finance are found outside the organization called external source of funds. So in this lesson, we are learning 11 parts of the external source of funding. Some parts are short term, some parts are long term. And in this part, there are so many parts of the questions are there ready to go through. So especially if you're working in a future, right? If you want to work in a financial department, the accounting department, you should definitely know what are the available source of finance in the business organization from coming from external fund. So external short term, I would like to go to the external short term finance, which is normally if you can see if you are making a SOFP statement of financial position in financial statement, we are classifying these things under current liabilities. Current liabilities, bank overdraft, trade payables, like the contract that you have to settle within 12 months, and credit cards. And there are mainly external sources, like long-term sources are there. Like we are classifying these things under non-current liability section. So I'll show you by using one of the like financial statement in the. Uh, I found this from the Colombo Stock Exchange. This is one of the blue chip company of Sri Lanka, John Keel's Group. So John Keel's Group, I downloaded the interim financial statement from 30th June 2021. So you can see here the consolidated statement of financial position, SOFP, or previously known as a balance sheet, is given here. So I'll zoom a little bit. You can see here the values are not actually important for us. Only just go through the headings. Just that's the main thing. Assets, you can see asset section is comprised of the property, plant, and equipment. Non-current assets, like these are the mainly they how they assets. They are like mainly investments, property, plant, and equipment. Intangible assets, their brand values and everything, and then deferred tax liability, other non-current assets are there. And current assets, the asset that you're keeping, the asset investment that you have, like you can keep less than 1 year, is called current assets, like your inventory. Trade pay, like other receivables, your customer values, and then amount due from other related parties and other current assets and everything. So that's a asset section, guys. So main important thing, like when you're dealing with the external source of financing, funding, the important section is here, the liability section. That's the mainly liabilities, external source of we are mainly talk about the equity and liability part. So you can see here under equity and liability, mainly our long term internal source of finance, mainly external coming from stated capital, right? Stated capital is an external source, stated capital, share capital, and long term funding. This is the these assets were actually funded by these things. Like these are the main sources. That's why if you talk about the SOFP, the balance sheet, you can find some one part is asset, total assets, and other section is equity and liability section. So that is this assets actually funded by these equity and liability values. So equity means normally external funding, stated capital of the business, and then you have a revenue reserve, retained profit. We talk about under internal source of funding, that is this, and also non-current, non-controlling interest and total equity. And this is our lessons today. Total liability section, you can see there are non-current liabilities and current liabilities. So these are this business organization. This is how they fund their non-assets and everything, asset structure. This is their capital structure followed by this thing. Non-current liabilities in long-term financing, external financing method. So they have insurance contract liabilities, some amount, and then amounts are not important for us. So just go through the headings. You can see interest-bearing loans and borrowings. That means they have taken some bank loan. That's called interest-bearing loans and borrowings. And lease liability, vehicle leasing, building leases. Leases are there. This company has so many leases. And deferred tax liabilities, that is the tax liabilities that you have to pay to the government. Employee benefit liabilities, so you have to pay for some employment, like a contracts. So like EPF, ETF, like provident funds and gratuities and everything, you have to settle. That's employee benefit liabilities, and other non-current financial liabilities and other non-current liabilities. So this is the main headings comes under here. But if you go to their notes, we can classify, we can find out what are these actually values are comprised with, right? You can see these are millions of values are there. All this is like, these are rupees in thousands. You can see the total non-current liability, they have 225 billion worth of non-current liabilities are there. And the values are just not mandatory. Just go to the current liability section. This is the external short-term methods. Short-term methods of funding. Under that, number one, we can see trade and other payables. trade and other payables. This is the liabilities that you have to settle within one financial year or 12 months for the suppliers. So this company, this is, we are talking about John Keel's company, Sri Lanka, one of the blue chip company in Sri Lanka. This company comprises of so many trade payables as well as customers. This company owns so many sectors like retail section, transport and logistic, and tourism, like so many business. This is like a large diversified business organization. So there are so many bills to pay for the customers, suppliers during the year. And what the value here they have to is like 28 billion they have to pay for this. This is a quarter, right? And amount due to the related parties, income tax liability they have to settle within 1 year, short-term borrowings, interest-bearing loans and borrowing. There are short-term bank loans over there, and it can be say like short-term like loans, lease liabilities that you have to settle, and other current financial liabilities, other current liabilities, and bank overdraft. So this section, what is a bank overdraft? What is a trade paper? What are the income tax liability? So these things, what is a lease liability? So these things we are going to, our main objective of this session is to find out what are the meaning of these things and what are the main advantages and limitations of taking these things. But anyway, we are doing a business organization. You can see the business organization has to bear with these things. So if you go to the classification of these things, like consider cash flow is there. That is our next session. And after cash flow, you can see if you go to the notes, you can find out how this actually liabilities, company financial statement, and the SOFP comprise with their segments. I'll show you their segments also, company income statement and SOFP. So if you go to the this section, you can see here the revenue section. You can see the revenue coming from, these are the business segment they have. Transportation, this is transport and logistic, and then consumer food, right? See, transportation section from 2020 to 2021 they have increased it 2 billion to 5 billion. Consumer good also increased, like mainly their food section, Keel's food products, 3.1 billion to 3.8 billion. Retail section especially, you can see massive gain is there, especially Keel's supermarkets. You can see 12 billion to 20 billion, 8 billion, like a massive gain, because a lot of people actually these days they're ordering online and everything. So it's a good time for them, even though there are other sections. Let's go to other sectors of this business organization. So yeah, they have other sections called property development and also leisure. The leisure means they are hotels. They are on the business. As I told you, it's a diversified business conglomerate. The leisure section also, you can see that actually a little bit improved, because I think they have given their hotels as some hotels they have given as a quarantine places, and that's why they increased to 154 million to 1.9 billion. Property section also a little bit improved. Property mainly they have like apartment, like Trizen apartment, and on like different John Keys property developments are there. And financial services mean they have banks, Nation Trust Bank, and also like other like financial services are there, like John Keys stockbrokers, John Keys, different financial arms are there. So that also improved 2.2 to 3.0 billion. So others also, that unclassified section, like some, it can be some import export. So totally the group total income has improved from 18 billion to 33 billion. It's a massive improvement, right? So and this is only just a profit section. Let's go to the assets and the liability section. This is the total assets section, so property, plant and equipment, and then after they have given the sector wise current liabilities and non-current liability section. This is the important section today. There are trade and other payables. You can see that also sector wise they have given for each and every section, each and every segment how much. For example, this is the first segment they're talking about. This is the transport and logistic, transportation, right? Transportation, especially they have the South Asian Gateway Terminal SAGT project in Colombo Harbor. So there you can see their current liability section there in this first column I'm talking about. Current liabilities, current non-current liability section. Non-current liabilities total that decreased a little bit because their terminal, I think, operation gone down, so they don't have that much liabilities. This decreased by 308 to 293 million. And trade payables a little bit increased, 1.1 billion to 2.4 billion. Short-term borrowings they increased 3.1 billion to 3.5. This is actually year on year. year-on-year analysis. That's why in financial statement, that's how we normally recognize. And then lease liabilities, none, this segment. And bank overdraft, 506 million to 718 million, right? Bank overdraft value increase. So that's segment wise. So like you can, if you go through this financial statement, you can find out in the note section, mainly the segment wise, transportation segment, consumer segment, retail segment, and then the other segment, property, financial service, other. So like that. So this is the important thing that you have normally, right? At the financial position, statement of financial position will be giving you kind of a like important sections regarding to this. Okay, let's go back to the our like one by one. Each of these external source of finance. Here we are going to external source of finance because of some certain reasons, especially we are use short-term methods sometimes, like bank overdraft, trade payables, and everything. We have to enter into contracts with them. Why? Basically, we need that the money for the following reasons. Some businesses have seasonal trade, right? Farmer, for example, may need to borrow money for a few months until revenue come in from selling the harvest. And also manufacturer may need finance to pay the raw materials and wages to meet large order. And also a firm might be short of money because it is waiting for a customer to pay. That's why like they're taking the bank overdraft, they're taking because of that. And business may need to meet emergency expenditure. For example, if a machine breakdown unexpectedly, if the repair costs might have to be met by short-term loan. So unexpected emergency funds also need to be in the case of machine repair or something. Urgencies are coming. So anyway, we need money for these things. Sometimes internal sources are not enough. So we have to go to the external source of money, that is finance obtained from outside the business. Under external sources, as I told you, the main one, I'm talking about the short-term method, short-term one, bank overdraft. Right, bank overdraft. Okay, I like to, Ranusha, can you read the bank overdraft part? Bank overdraft section.
Bank overdraft. This is a common source of finance for most businesses. A bank overdraft means a business can spend more money than it has in its account. In other words, they go overdrawn. The bank will set an overdraft limit, and interest is only charged when the account is overdrawn. Bank overdrafts are simple and flexible. However, the bank has the right to call in the money owed at any time. It may do this if it thinks the business is struggling. Business may use bank overdrafts as a short-term source of finance.
Thank you. Mainly that's why as a short-term source of finance, they are using this bank overdraft. Here also you can see in this financial statement, this is the, like I told you, John Key. So whatever the organization is the biggest organization, like this diversified section in Colombo Stock Exchange. So their bank overdraft section, you can see the group, like, financial position. If you go to their bank overdraft section, the bottom, you can see under liability section, the bank overdraft value. You can see they have for this period 14 billion bank overdraft. That is 11. Last year 2020 is 11 billion. So 11 billion to 14.5 billion bank overdraft increase. So what is this accounting financial period from as at 30th of June? For actually this is a for semi-annual financial statement for about 6 months ended. So like that, so every organization, even this organization is one of the largest business in Sri Lanka. That's why they have to go with the bank overdraft, even though they have so much of assets, right? They have, for example, if you check their bank values and everything, if you go to the current assets, cash in hand, so cash and bank, so they have 17 billion cash at the moment, right? The last year was 19 billion and 17 billion, but still they went to a bank overdraft of how much? 14 billion. Because why? They have to depend on the liabilities because they have to improve the liquidity, right? So you can't settle, you can't buy everything by giving cash because there's a working capital cycle. So they have to always, whatever the amount of money you have, they have to still go with the credit transactions, credit like liabilities and everything have to create, because even though they have short-term investment, look at short-term investment, 88 billion short-term investment, but still they go ahead with the bank overdraft. Sometimes you might ask me, sir, why they have this much of assets? 52 billion inventory, right? And then this much of 88 billion investment. Sometimes this might be share market investment or something. But why they have to go with the another bank overdraft? So can't they settle their loans and liabilities like with that 88 billion? Now they have 14 billion overdraft. Why they want to go with like this kind of a liability? Why they want to go with like 1.4 billion lease liability? No, this is important, this is relevant, because sometimes every organization, because if you talk about this company, they have like a subsidiary businesses are there, like as they are operating all the segments in the economic activities, transport and logistic, financial services, insurance services, and also retail section, consumer good. So each and every business, sometimes they don't have, for example, hotel segment right now, they don't have enough money, so sometimes they have to take the bank overdraft, right? So, but group wise, you can see if you talk about the group wise, they have a lot of money, but liabilities also we have to taken, because the group wise, we taken single individual firms in their subsidiary companies, they have to take some kind of a loan because there are some emergencies, there is some like a shortfall of cash, there is no proper income coming these days. Like for example, their supermarkets performing very well, but their tourism and transportation, tourism and the hotel segment not that much profit, because you can see because of the pandemic case, tourism industry is zero. So like that, because of that, sometimes they have to go for the loans and the liabilities. That's why. So it's always we can justify why they want a liability. The bank overdraft is a very important thing. If you have a bank account, especially current account, we call bank account, there are several types are there. So bank current account holders, the bank is giving a facility, that is you can use amount more money than you have. Like you can use a checkbook for that purpose. You can pay your bills, you can pay your liabilities by using a check. For example, imagine you're maintaining a current account with 10 million, but for a business transaction, you have to like you purchase from like 50 million worth of item from a supplier, but you have to pay for him like somehow. So you can give him a check of worth 50 million, but you can ask that person, okay, give it like a 1 week or 2 week or 1 month. So today is the 6th of September, so you can say, okay, give me like a 1 month. 6th of October, I'll give a check, which is you can realize on that day. And so you can ask that overdraft facility from the banker. So I'm going to give a check like this amount. So in case if person actually asks the money and that day, if I doesn't have enough money in the account, please give. That's a loan. So that's a short-term borrowing. You can see the definition. It's a agreement with the bank where business spend more money than it has in its account up to an agreed limit. So overdraft, there are two methods of overdraft we can see, like temporary overdraft and the fixed overdrafts. Temporary overdraft means the limit is normally can be negotiable. It's temporarily, like in case immediately sometimes there are bankers giving a facility for you. But fixed overdraft means you can in advance, you can go and meet the bank manager and you can get some facility with the bank. For example, imagine you have a business, and your business you have 50 workers in the business. Every day, let's say 25th of every month, you have to pay their salaries. So payroll will be you have to implement activated on 25th of every month. So the 50 workers, you have to give, imagine 5 million worth of check. But every 25th of month, sometime 5 million will be not available in your account, right? For example, I'm talking. So in that case, but you cannot actually that paycheck you cannot actually implement it. Sometimes you can't pay this, you can't settle all the employee salaries, which is not good. Therefore, you can ask some facility from the bank manager every month at 25th of every month. I need to have 5 million account in my current account. So this check should be, whatever the situation, under whatever the circumstances, this check should be implemented. So bank can agree with you. So sometimes you might have 6 million, then no problem. But if you have 4 million, bank will you extra 1 million, and then the check will proceed. Some months you might have 10 million, so then no problem, no need to get overdraft. Some months you might have 2 million, the bank will give you extra 3 million, like that. So that's how overdraft will be performing. Some business, now the past papers, sometimes they ask to define bank overdraft. Define questions. Sometimes these questions are coming, or define the term bank overdraft. So that's the one thing. And sometimes they're asking analyze the imports, sometimes analyze question, 6-mark question. So main advantage of bank overdraft is very quick and more flexible, and the bank overdrafts can be negotiated. So emergencies is very, very, very helpful. In case of financial urgencies, you can take a OD and you can settle it. But the main limitations of bank overdraft is the high interest cost they have to pay. the bank overdraft, they are charging the interest per day wise, daily basis, they're charging the interest for the loan. So it's better always, if you take a facility bank overdraft, better to settle it immediately, ASAP, as soon as possible. It's better to settle the bank overdraft, because daily basis they are calculating the interest for the amount that you obtain, right? That's why interest wise, very high interest part is there to pay. Administration costs also. So another thing, advantage is the bank order, you don't need to give any collateral, like like bank loans. This case, you don't need to give any collateral. So bank manager will give you that amount by based on the business, the confidence, based on your business background, based on your past track record, like that. So second source, they are going to talk about the trade payable. You can see here this business source, there are massive trade payable value, 28 billion. So this month, actually this year is gone down from 35 billion to 28 billion, right? So like it gone down 35 billion to 28 billion, right? Okay, I think I got a question from the chat line, the student asking bank overdraft, how much is the interest part? Yes, it's a good question. So bank overdraft right now, interest rates goes around like it was there about 28% like last year, but Sri Lanka, this government take a decision to reduce it for a little bit, and then now I think bank overdraft interest goes around but around 20%, 15% to 20% around. That's actually depending on like bank to bank. You can negotiate it, but normally high interest rate is there, right? If you go to bank loan, bank interest rate would be like about 9%, 10%, but overdraft interest rate is like double, 20% something, like it's very high interest rate you have to pay for the overdrafts. That's why overdrafts are normally unhealthy for a business organization, but it is important sometimes. Like John Kills also, they have 14 billion overdraft value, right? Within 12 months they have to settle this. So like that, and so that's the thing. I think that high interest rate like that around, it was there about 28%. Even credit cards also like same thing. Credit card also high interest rate, like same amount. But that's depend on country to country, government to government. This depends. But in like most of the Asian countries, the bank overdraft rates are very high, because a very good income for a banker to facilitate that funds in emergencies for the business organizations. Right. The trade payable part. Okay, trade payable part, I like to invite Tessa. Can you read that trade payable section? Trade payables. Trade payables are very common. You can see like every business organization, like when you're doing buying and selling, here this business also, we have 28 billion trade payables. Let's go to the like a segment wise. You can see trade payables mainly coming from, we have this business, have a supermarket business, like John Key supermarket. So here you can see that trade payables are very common, because if I'm a supermarket, if I'm supplying them, for example, Key supermarket, I'm a vegetable seller. So they settle my bills like within 4 months. They are settle their liabilities within 4 months, trade payable. So that's why this working capital cycle goes like that. So trade payable is ranging from different companies. So here in the textbook it says like from 30 to 90 days, which is 1 month to 3 months. But in literally normally the business organization, it depends actually. Some months, 4 months are there, 128 days, sometimes 6 month credit terms, like 300 days, like sometimes 10 months. So like that. So there's from organization giving so much of time, like especially textile business, they are giving 3 months like credit terms. But Keel supermarket, I know about, they're taking like what 4 months from the suppliers to settle their bills. So imagine, so they have enough money to circulate, so they can sell my vegetables and all my supply for in the supermarket. So because those are fast moving consumer good. After that, what happened? They can quickly then deposit their money into their account, and after 4 months, I'm getting my check. But my contract is I had to every day or something like say as a twice a week, I had to go and supply my items. So every month, imagine I'm supplying 1 million worth of vegetables to supermarket. And then so they are giving like after this is a month of in a September check, I will get in October, November, December, January. So next year January only. So I will get in that check. So that's called trade payable story. Okay, trade payable, I would like to invite. Okay, Divane, can you read that trade payable section?
Yes, sir. Trade payables. Businesses often buy resources and pay for them at a later date. usually within 30 to 90 days. This is called trade payables or trade credit and is a cheap way of raising finance. It means a business holds on to its cash for longer. However, it has its downside. Many suppliers encourage early payment by offering discounts. The cost of goods is often higher if firms buy on credit. Delaying payments may upset suppliers.
Okay, thank you. So mainly trade payables have its own advantages and disadvantages. It normally is important when you're doing buying and selling business. It's a way of raising finance because other thing you don't need to pay any interest for them. Trade payable, if you purchase them from items like from them, like you bought 10 million worth of items. Let's say you're in textile business, you bought 10 million worth of item from a trade, so some supplier in the market, and then for that the him actually say, okay, give me within 3 months you can settle me. So what you can do, you can sell in your business organization and then you can settle the money within 3 months because that's called the working capital cycle. But if you're purchasing from trade, sometimes items the prices are a little bit higher because he's, even though he's not charging an interest amount, but you have to accept his offers and prices. You cannot negotiate and bargain with this person because the person always giving you credit facility for 3 months, 4 months. That means he's investing. He's giving you his supplies and inventory for you to sell for a 3 months or 4 months period without any interest. That's why sometimes the prices are a little bit higher. That's it. I think that part. They say the point number 2, the cost of good often higher if firms buy on credit. So, and other thing is another downside is supplier encourage early settlement, early payment by offering discount, like early settlement. If you settle within 1 month, if you settle within, okay, I'll give you 3 months, but if you settle within 30 days, I will give you 10% discount. So a lot of people, what happened because of that, they encourage to pay early and settle the bill in order to get that discount like that. So this is like credit management principles, like normally from even you can apply for the customers also. For your customers also, you can say, okay, early settlement, I'll give you 2 months period, but if you settle within 1 week, I can give you 5% discount. Then you can immediately collect the money for your sales. So that kind of methods are available, even though you have trade payable thing. But a lot of businessmen, even though they are giving discount, they cannot settle like that fast. That's in business reality like that. And the other thing is like normally, I mean, business world, the competitive advantage is coming with the amount of the time that you can give. For example, I know one person who importing chemical and everything, and he say like normally in the industry in PETA, normally chemical, all the business sellers, their competition is based on how many credit terms, credit period they are giving. Some business give it them for 2 months, some businesses for 3 months, some business for 6 months. So always customers are going to the businesses which give like a more time period to settle. So 6 months. But my friend told me, so we can't actually afford 6 months. How we can actually, we have to invest and we have to wait for 6 months until we get the check. So therefore he actually operated for a 3 months credit period policy. But he says that because a lot of companies are there now, they're offering 6 months, 7 month credit periods to do the business organization like that. So it's very, very important, like in a business organization, trade payables, trade receivables, you have to mainly import. This is main 2. That's why when you're making this one, current liability number 1 is trade payable and other payables. Trade and other payables is number 1 classification here you can see under current liabilities, right? In current assets section, you can see the trade receivables section coming in number 2 after inventories, according to the liquidity preference. First one is inventory. Second one is the trade and other receivables, customer value. And this is the supply value. So supply is the number 1, you have to settle, right? And there are other income tax payables, short-term borrowings, lease liabilities, everything. So this is about trade payable. So you have to know mainly advantage and disadvantages of a trade payable situation. And the other one is a credit card. The third one is credit card. Okay, I invite Samara, can you read the credit card section?
Credit cards are popular because they are convenient, flexible, and avoid interest charges if accounts are settled within the credit period. Executives can use them to meet expenses when traveling on company business. Small businesses use credit cards to buy materials from suppliers. However, interest rates on credit cards are very high if accounts are not settled within the credit period, usually 56 days. Sometimes a business will need to borrow money for much more than a year. This is called long-term finance, and some examples are discussed below.
Okay, thank you. So credit card is another short-term method of finance. Like credit periods normally 56 days, definitely, sometimes 45 days and 56 days. So Sri Lankan, I know that even internationally, credit card companies are there. American Express, Mastercard, and Visa are the main three companies who operate the credit cards, and they are giving their service to the bankers. So every bank in Sri Lanka, they are offering, all the commercial banks in Sri Lanka, commercial banks, Sampath Bank, HNB, like Standard Chartered, HSBC. So all these companies, they have credit card facilities. So what they do, they actually call that main credit card company international, Mastercard, Visa, or American Express. So and then they can give a credit card for a person. That's like for consumption purpose only. Even Sri Lanka recently also, credit card actually again changed the rule again, because some people actually used to buy, even that happened to one of my student also. He actually used to buy some bitcoins using credit card, and then after that his credit card was suspended from the bank, because they say for investment purpose you can't use a credit card. So credit card payments you can buy anything, like it's mainly for shopping purpose, for consumption purpose. You can buy food, you can buy books, you can buy textile, you can subscribe for the Zoom, you can, right, you can, like anything, like from the consumption purpose you can spend from credit card, but not for the investment, right? You can buy shares from using credit card, because the capital nature of the transaction. You can't buy bitcoins using credit card. It's a capital nature of a transaction, like that. So credit cards are mainly we are giving the purpose of like substitute money, because always carrying money in the wallet is sometimes dangerous and some inconvenience. So this is because of the like a convenience money. Anyone can use credit cards to pay and their bills, to pay their expenses, anything you can buy. There are certain credit limits are there for different customers. So we call silver package, platinum package, gold customers, like that. Bronze customers, silver customers, gold customers, platinum customers, like that. Credit limits will depend on the customer's income, right? So you can, some people are there, they have million values of the credit card limits are there. But on the other hand, is they have to understand the credit card usually carries high amount of interest. That's about 28%. Recently, it was actually reduced by the Sri Lankan government, but normally, usually credit card interest rates are very high, because bankers also wanted you to use their credit cards more frequently. Sometimes they are giving like some promotions for, especially for credit card. For example, hotels. Sometimes they say, okay, if you use the Sampath Bank credit card, 50% off for this hotel, 40% off only for credit card. So if you're giving cash, they are not giving that discount for you. Therefore, definitely a lot of people, they go ahead to the credit card offers for dining, for hotel, right? Everything. So they have credit card offers are coming. Sometimes, Pizza Hut, they are giving like buy one, get one free offers for some credit cards. That's right, but not for money, but for credit card purpose only. The main thing is, if you are using a credit card, you have to be very smart, right? The main thing is within 56 days, you have to settle it quickly. So my style is normally, I also using a credit card. So as soon as possible, within 1 week or 2 weeks, definitely I'm going to settle it, because otherwise they're charging a huge interest rate. Example, if you have to pay a small amount, they're charging a huge interest rate for that money. That is very unfortunate incident. That's why always you have to keep in mind what are the credit card, like the accounting, like a billing period, and you have to quickly settle that amount within the given time period. So that's an important thing. So like this is mainly it's a personal kind of a thing, like credit card sometimes, because for corporate credit cards, it's normally, because if you go to this company, we can't see, there's no credit card kind of a thing. Sometimes can be other current liabilities, but normally credit cards are given for normally for like mainly not for corporate, mainly for the business, like individual purpose. Like sole traders, they might use a credit card. Sometimes partners, they might have a credit card, right? Sometimes chairman might have a credit card. Sometimes for chairman might be used, for example, for subscribe the Zoom and everything, upgrade the Zoom. Sometimes he might use his own personal credit cards for that. So that again, business can reimburse that amount, like that. So credit card means a very popular because of this convenient thing, flexible and avoid the interest charges. So other part is a debit card thing. So debit card, there is no interest part, because you are spending your own money, right? So executives can use them to meet the expenses when traveling on company business. Like that, you can pay for hotels, and you can buy some materials from suppliers, everything. main advantages are those things, and also the disadvantage is high interest cost, and you have to always make sure that you have to settle within that one period, like 56 days or sometimes 45 days. Okay, so that's our third one today. We discuss, we talk about the bank overdraft, we talk about trade payables, we talk about credit cards. Okay, let's go to the fourth one, loan capital. Okay, loan capital is a small amount in everyone. Actually, every company loan capital is there. It can be short term or long term. Loan means you can see here current liabilities. Also, we can find out interest bearing loans and borrowings, like short term loans, that is they have taken within, you have to pay within 12 months loans. And if you go to the non-current liability section, also you can see here the non-current liability section, also we have interest bearing loans and borrowing, same figure, interest bearing loans and borrowing, interest bearing loans. So what is this interest bearing loans? So every loan you have to, there are interest bearing loans and borrowing. So these things you have to understand, these are short term and long term loans, right, which is coming from especially banks. So loan is a fixed agreement between a business and the bank, right? Keep in mind, it can be bank or it can be finance company. So the amount borrowed and interest must be repaid a regular installment over a fixed period. And the bank loans can be short term or long term source of finance. That's why we normally, it can be short term or long term. That's why in this case we classify it in both sections, and the non-current liability is long term, and current liability, this is short term loans. So even for us also, because individual level also we talk about, not the business level, individual level also we can apply like a short-term loans and long-term loans from bank, like personal loan. For example, you want to do some exam, like, you know, masters or it's something in future. So you can apply for a like education personal loan that you can say, okay, I'll settle within 1 year. So that's a short-term loan. Sometimes you can obtain like a, okay, I want to buy a car. So vehicle loan you can go. That's a long term. You can say I'll settle within 3 years. I'll settle within 4 years. So that's a long term loan. So anyway, it can be short term or long term. The main advantage of a bank loan is that the business will know exactly what it has to pay every month. So that's the liability is fixed. So installment, you know, definitely, okay, how many periods. Bankers are actually, they are giving you nice like a proposal for you. Okay, this is the, if you pay that within 1 year, you have to pay monthly installment this much. If you settling within 5 years, your monthly installment will be like this, like that. You exactly know, you can easy to, because of that, it's easy to manage your inflows and outflows, because you know exactly how much of money you have to settle for the bank loan at particular date. So you can make even standing order also in that case. So we talk about this thing under Maurice Abaya, the taxi driver case study. He took a bank loan in the getting started question above. Okay, the other part is unsecured bank loan. Sometimes you might be wonder, what is this, right? Loans are we talk about here. What is this unsecured bank loans? Secure and unsecured. Secure means, you know, secure, you know, pledge, the collateral that normally when we are giving a bank loan, when you are getting a bank loan, we have to provide some kind of a security for the banker, because that is the normal nature of the business. They ask you, okay, I can give you the loan, but you have to provide me some kind of security in case if you are not paying this loan, we can actually take the property and we can settle our liabilities like that. So normally housing loans, normally the land, sometimes you can mortgage the bank, right? That means when vehicle loan leasing, the absolute ownership of the vehicle is goes to leasing companies. They have the book of the vehicle. You are just using the vehicle. Same thing, even the housing loan also, the deed of the house, the deed of the property belongs to bank, and then we are only just taking it over the 10 years or 5 years, you are settled the loan, and at the end only they are transferring the deed back to the customer. Same thing here, unsecured bank loan means there is loans are, they are not taking any security, just giving personal loans. This means that the banks lend money without the security of having a claim on your assets. If you do not pay it back, therefore the business collapses, the bank might not get this money back, right? This is very rare in Sri Lankan world, because unsecured bank loan system was very risky because without any collateral, no one giving you. So they are keeping something for the business in case of a collapse or something like this kind of situation, you know, pandemic case, so many business collapse. So then if you have a collateral or something, so again, you are going to lose that. So this case, consequently, banks would prefer to make secured loans, but some businesses might find it difficult to get an unsecured bank loan. And this is because they present too much risk for banks. Interest rates are higher for unsecured loans compared to the secure loans. Secure loan, unsecured loan. But keep in mind, unsecured loans are very rare to find. You can go to John listing. We don't have any unsecured loan here. Everything I think you have to provide some kind of a every non-current liability, financial liability, or lease liability, deferred tax liability, everything you have to keep some collateral, right? Collaterals are there, but unsecured loans are there in UK and other countries. They are giving some bank loans without any security, just giving you. It's very rare to find. And next one is a mortgage one. So today we talk about the number one, bank overdraft, number two, trade payable, number three, credit card, number four, bank loan, number five, unsecured loans. So number six we are talking about today. 1, 2, 3, 4, 5, 6, mortgage. Right. Mortgage is very common. If you talk about that, the mortgage is like a in US financial crisis came because of this mortgage loan thing. The credit crunch, we call the financial crisis, happened in 2008-9 period because of the mortgage loan. Like a lot of people actually taken mortgage loans, but suddenly the property value goes down and bankers couldn't recover the value of the loan. So the banking system collapsed during the Barack Obama's time, if you remember, right? So about like not 2009 is like about 11 years ago. So you can see that's mortgage situation. So mortgage is a long-term loan and borrower must use the land or property as a security. That's an important thing. Like you have to give your land or property. So if land value goes down or property value goes down, it is very very rare thing. Because normal land values and property values always increasing. That's why always bankers prefer to give you mortgage loan, because they know always market value of lands and buildings and like properties are going up. But accidentally, sometimes property value can be going down, go down, like like that's happened in 2008-9 situation. So this means that if the borrower fails to make the payment, it's very what you call realistic. If you're unable to pay, the lender can repossess the property. Like banker can ask you, okay, then so you can't pay the loan, then I'll take your property and I'll sell it for you, and I'll recover my loan and I'll give you, if you have extras, I give you some excess money for you. So then repossess the property. And mortgage are very popular because the interest rates usually low. That's the main thing. So a lot of people actually taken mortgage loan because comparative to other bank loans, like normal bank loan goes like 15%, 14%. But mortgage loans normally goes like about 5% less than, like 5%, 3% less than that, because they have security on unsecured bank loans. Mortgages may be taken out for but up to 25 years. That's the thing. Sometimes 10 years, 15 years, 25 years. So it's very wise decision to go for a mortgage loan if you are actually buying some property, an apartment or something, because you can buy an apartment from you mortgaging it, and then you can pay like for the duration of about 20 years, 15 years, like a long time. Because the thing is, apartment, you can use it or you can rent it for someone. That's what a lot of people are doing. They are buying apartments with the mortgage loan, and as soon as they purchase the apartment, they're renting it out to someone, and from rent income they pay their loan bills and everything. So the installments, mortgage installment, they pay. So at the end of the 10 years, 15 years, then what happened? Automatically loan also settled and the property also definitely transferred to you. That's a lot of people they are doing. Apartment business is a really good business, like real estate market. A lot of people will go with the mortgage facilities, bank loan facilities, and then they settle the bank loans over the period from the rent income, right? For example, if you can purchase an apartment, you can rent it out for example, Colombo apartments goes around like sometimes about 2 lakhs. So it's a good apartment. Sometimes the new apartment, you can sell it for 3 lakhs. But I think, especially for diplomats, like foreigners, sometimes I know a lot of people who are doing this business. So, and then they can settle directly the rent income, they can direct to the bank, and the bank loan will be settled with them. So this is a very good business. Like the time value also in the apartment value also increase. If you feel you can if you want to sell this apartment, you can sell it for a good price. For example, the apartment that you purchased for 20 million, sometime after 3 years, you can sell it for 30 million, right? 10 million profit. So, and if you don't have intention to sell the property, you can rent it out Okay, so mainly these are the main 6 methods, like a half of the external part we discussed today. We talk about the bank overdraft, trade payables, credit cards, loan capital, unsecured bank loans, and mortgages, guys. So in my next session, I'm going to discuss about mainly about the other main methods like external sources, including important like crowdfunding, venture capital. You might be very interesting about that thing. So next session, I'm going to talk about that. So I think this 6 session, I think you clearly understood that what are the good points and the bad side, the limitation of each and everything. All right.